Hello everybody. This is lesson 22 of the lecture International Economic Relations. I will discuss slides 1 to 20 of chapter 4, International Financial Market Crisis. As we have seen in the preceding chapters, the openness of countries to international trade and capital movements can bring a number of important advantages. It has, however, also repeatedly resulted in financial market crisis episodes, which easily spread across many countries under these conditions and often causing crises in the real economies of these countries too. This chapter deals with historical financial market crisis episodes and above all the similarities in the formation and the cause of these crises are examined. First, we will however discuss theoretical approaches to explain why financial market crises can occur. The formation of speculative bubbles plays an important role here. Nearly all episodes of historical financial market crises followed a similar pattern. It typically starts with a price increase over longer periods of a particular good or asset. The prices begin relatively slowly and then leads to increasingly stronger and ultimately exponential growth. Finally, the price rise abruptly ends and a steep price decline occurs in a relative short time. A recovery will then start only in the long run again. This observable pattern is explained quite well by the theory of speculative bubbles. According to this theory, the emergence of financial market crises is always probable when the following conditions are met. We can call these conditions also the ingredients of a financial market crisis. First is an initial shock that starts the bubble. I will give you a couple of examples what can cause such a shock. Second, and perhaps most important, is a positive feedback mechanism that helps to blow up the speculative bubble. And then we need a funding source to finance this positive feedback mechanism. These three conditions are necessary to create the speculative bubble. To make the bubble burst, we typically need a negative shock large enough to overcome the reason for a price increase. As we will see, such negative shocks can be of really random nature. I will give a couple of examples for this type of negative shocks in the following. Let's go through these ingredients of a financial market crisis step by step now. Most historically observed financial market crisis episodes were started by an unpredictable event, a shock. As we will see, such shocks can be technological innovations like invention of new products, services, production technologies, or the discovery of new raw materials. Very often, an initial shock can also be a change in financial market innovations. For example, innovation of new assets like stock funds, derivatives, or the development of new investment strategies. Sometimes also financial market deregulation can be the cause for such an initial shock. Financial market deregulation means less restrictions concerning prices, own capital rules, scope of markets or cooperation. And even completely non-economical factors or events can be an initial shock, like the change of governments or the end of wars, as we will see. To blow up the speculative bubble, a positive feedback mechanism, or also called a positive feedback loop, is necessary. What is such a positive feedback mechanism? It is an event which reproduces the conditions of its own creation. Positive feedback mechanisms can appear in quite different systems. It can be physical systems, it can be biological systems, or it can be economic systems. Markets for assets have a susceptibility for such feedback mechanisms if people rely on so-called naive expectations. Naive expectations are given if people believe that the currently observable increase of prices will hold on in the future. For example, people which believe that next month increase in stock prices will be equal to the current increase in stock prices have naive expectations. One can describe such a positive feedback effect with the help of a circular graph. So let's assume that due to an initial shock, such as a technological innovation, a large group of market participants form the expectation that the price of a stock company will rise. If a large number of people believes this, then they will purchase this asset in order to profit from the price increase which they expect. If, however, a large group of market participants purchases a special asset, then the demand for this asset grows stronger than the supply. The result will be an increase in asset prices. So what people have expected has become reality because they have expected it. This is what we call self-fulfilling expectations. In this case, they are justified because they are based on the information that a stock company has been successful in creating a technological innovation. But if market participants now rely on naive expectations, they will once again increase that the price of this asset will grow in the next period. Even though, from an economic point of view, there is no actual reason for this. And then they will again purchase this asset such that demand grows stronger than supply, such that the price increases. And if they rely on naive expectations, this circle will go on and on. And the bubble will blow up. So these naive expectations are not compatible with standard assumptions of neoclassical theories. They are not compatible with the assumption that people are rational. As we will see, there are, however, also assumptions under which speculative bubbles can be compatible with rational behavior. One can also show the emergence of a positive feedback loop with the help of a market diagram. Markets are usually negative feedback mechanisms. This means that market equilibria are usually stable. Let me first show this. If the price exceeds, due to random fluctuations, the market equilibrium price, the result will be a supply of this good or asset which is larger than the demand. So the result will be excess supply. Excess supply, however, causes downward pressure on the price such that the price will fall back towards the market equilibrium price. If the opposite happens and for random reasons the price falls below the market equilibrium price, then demand will be larger than supply such that the result is excess demand. If there is excess demand, there will be upward price pressure such that the price moves again in direction of the market equilibrium price. This means that deviations from the market equilibrium price are corrected again and again by market forces. The market equilibrium is under these conditions therefore stable. Speculative bubbles cannot develop under these conditions. This is an example for a negative feedback mechanism. A negative feedback mechanism is always stabilizing a system. It's different, however, when it comes to storable goods and market participants which form naive expectations. Let's start assuming again that new information, for example reports that a company has received a patent for an innovation, is expected to increase the price of shares so that the demand for the stock company's shares increases. This leads to a rightward shift of the demand curve due to the expectations of a higher price level. The result of this increase in demand is an increase in the price level. Now, if people form naive expectations, they will again assume that this price increase will go on over the next period. And then they will again demand more from this good in order to profit from this price increase. As a result, they will buy this good, which will drive the price upward, and the bubble starts to blow up the price development. Due to naive expectations, now the same will happen again and again, so this demand curve will shift to the right again and again, and the price will increase again and again. The result is that the price moves away from the initial position and moves away from the position that was justified by price increases due to the innovation activities of the company. The other price increases are merely based on naive expectations. If there are naive expectations, markets will be susceptible to positive feedback loops. In a sense, naive expectations transform markets from negative feedback mechanisms to positive feedback mechanisms. If people keep on relying such naive expectations, prices will steadily increase from period to period. Only a negative shock that is large enough to lead to lower price expectations can then interrupt such a positive feedback mechanism. If people rely on naive expectations even after the negative shock has happened, it is likely that now the opposite happens, namely a negative speculative bubble results, which causes a speculative undershooting of prices. To keep such a positive feedback loop running, a funding source is necessary, which means people must have the financial means to buy the feedback asset again and again. As history shows, there can be different sources of such means. One source is the restructuring of portfolios. For example, less demand for fixed rate securities in favor of more demand for the feedback asset. Sometimes also selling of real estate objects can be a funding source to make investments in stock, for example. So there are various possibilities of restructuring a savings portfolio. Another funding source, which has quite often played a very important role, was an increase in money supply, which goes hand in hand with an increase in credit supply. Central banks are able to provide this increase in money supply and finance in this way the creating of a speculative bubble. Another funding source can be foreign investment, for example, due to an economic opening of a country for trade and capital flows. Finally, the acquisition of foreign wealth can also be a funding source. For example, discoveries of natural resources in foreign countries, colonialism, or war reparations. In order to break the positive feedback loop, a negative shock must occur which is strong enough to overcome the incentives for further speculative activities. Such a shock can be merely accidental or it can be caused by political developments. In the history of financial market crisis episodes, however, as we shall see, changes in monetary policy often caused such negative shocks. Now let's finally come to the questions whether speculative bubbles can also be rational. Theoretical analysis has shown that it is possible to state two sets of assumptions under which bubbles can actually be compatible with rational behavior. I will discuss here in the video presentation only one that can be explained without using too much mathematics. This type of bubble can be called exponentially growing and finally imploding bubbles. They are possible if the price increase is large enough to compensate holders of a bubble asset for the risk of bubble implosion. Since the risk that the bubble implodes is growing with the size of the bubble, such risk premiums must also be constantly growing. That means the price of a speculative bubble must grow faster and faster in order to provide this necessary increase of the risk premium. And it is possible to show mathematically that such an exponentially growing price must finally cause an implosion of the bubble, because if the price increase is already that large that it is nearly vertical, it cannot grow faster, and then it is likely that the bubble will burst, and within relatively short span of time the prices will fall quite strongly, as described here by this downward vertical arrow. So the life of such a speculative bubble will therefore be typically quite short. The result of this analysis shows that this type of rational bubble has always to burst at some point in time, given its basic construction mechanism. However, with a little bit more mathematics, it's also possible to show that if market interest rates are below the growth rate of GDP, so-called macroeconomic speculative bubbles can appear, which do not necessarily have to burst. This type of bubble is explained by the digression on slides 18 to 21 in the lecture notes of this chapter. So much for this lesson.